welcome to the Going Long podcast. Our guest today is Brian Moynihan, Chairman and CEO of Bank of America, one of the world's largest financial institutions serving clients across consumer, corporate, and investment banking. Under his leadership since 2010, the bank has focused on responsible growth and long-term stakeholder value. And importantly to us, Bank of America is a member of FCLT Global. Brian, welcome to Going Long, and thank you for joining me today.
Yeah, it's great to be here, Sarah. Hopefully you're having a good start to the new year.
Yes, happy New Year. So as we think back, let's go back a little bit in time. And you assumed the leadership of Bank of America in 2010. And that was clearly one of the most turbulent periods in the financial services history, at least over my career. So to us, this was sort of a classic short-term, long-term issue, which is how do you get through the short-term problems that were going on at that time, but also at the same time, set yourself up to succeed over the long run. And coming out of that, Bank of America emerged with a simplified business model, stronger capital position, and a different risk profile. So could you walk us through how you balanced that immediate crisis management, the demands of that with this longer term institutional rebuilding, and what strategic decisions you made then that are still important in shaping your competitive position today?
Yeah, so I think you need to rewind the tape a little bit about that period to go. So what happened from the period of 2003 to 2009, Bank of America had acquired at first a company called Fleet Boston, which is another major bank, MBNA, which is a major credit card company, LaSalle, which is another smaller bank but filled in Chicago. Then they acquired U.S. Trust, which is a private bank. And then we acquired Countrywide, which is a mortgage company. And then we acquired Merrill Lynch, which is both a financial advisory force and a capital markets investment banking platform. So that was literally from the fall of 2003 to January 1st, 2009, all those deals were signed and closed. And so think about, over the period of 6 years or so, you had this massive change, and think about all the people who came into the platform who didn't have a long-term history of the platform, didn't understand it, and all the fundamental change. And then, of course, you end up with an overheating of the markets in lots of different ways, including the mortgage market, over borrowing, over lending, et cetera. And, this expansionary period that just blew up. And so, that started in 2006, frankly. In 2007 is when 2006 falls, when housing prices quit going up, and then it worked its way through all the balance sheets. So think about us of ending up with 20% of all the loans, mortgage loans in the country, about 15% of all the credit cards in the country, a major capital markets platform that was acquired from people who weren't regulated. Honestly, Merrill was not regulated because it was outside the banking tent. And then you put that all together and you ended up with just a lot of stuff that you had to deal with. And we had our own fund that caused too. So that was really the situations faced. So then the question is, what do you do about it? And you had three pieces to it. One was underneath that you had if you go back to the old adage, you want to be 1, 2, 3 in every business. We were 1, 2, 3 in every business. So we had great businesses that were there and had to be able to operate untethered from the issues of the day, week, or month, so that they could gain share. Then secondly, you had the sheer cleanup. There literally was a physical amount of work. We went from 10,000 people working in mortgage servicing to 50,000 people working in mortgage servicing over 24 months, to give you a sense. So you had the sheer work to get done. And then third, you had the regulatory environment, which was redefining, frankly, what they thought went wrong. Whether they're right or not, you had to deal with that. So those three things together. And then fourth, I think, and maybe I should add another one, you had a huge brand issue, which is the whole banking industry as a whole. Our company, as a particular participant, were baited about as being not good citizens to help the world grow well, and had been focused, frankly, going to your all charter on short-term profit over long-term thinking. The industry across the whole world, because this didn't go on in the United States, have been focused too much on too much leverage, too much short-term profit, too much trading principal profit as opposed to long-term customer profit, et cetera. So that's what we had. So what do we have to do? We had to divide it into thought process. We had to sit there and say we had to put the past behind us and clean that up. We have to then let these businesses just take off and keep going and have organic growth. We have to then deal with the regulatory changes, which basically doubled the capital requirements to make it simple, which meant you had to retain a lot of capital. So when your stock was cheap, you couldn't buy it back. So therefore, you had to be thinking about how to handle that. And then then you had to restore the brand and the capabilities, not only the brand of the company, but the brand of the industry and the brand of Bank of America as a participant in that industry. And we went from being hero for rescuing Countrywide to being goat for sort of the issues after Merrill Lynch. And you're saying, wait a second, we also rescued Merrill Lynch from going into bankruptcy. And that was but it got turned around. So that was the four challenges. And the way we went after it was to focus on those long-term things. What's the purpose of what we do? To serve customers and clients and do a great job from help interface. Focus on that. What do we do for them? Even the groups that were going through issues, get them focused on what they do every day. And then, frankly, we made money, even though we took a $20 billion charge in a single quarter. We made money every year, not a lot of money, and that became more money and more money and more money. But what you had to do is you weren't going to get there unless you really had the customer side and the teammate side, and then the communities come along, the stakeholders out there, and ultimately the shareholders would benefit. But you had to keep balance that you could have done even more things for short-term profit in that time frame that would have hurt you longer term. And, that's what we did.
Well, even if there hadn't been a financial crisis in that period, given the number of acquisitions that you talked about and so on, that would have been a big job on its own. So, but it was a big job, and then the rules were changing, and then, as you said, the reputational issues were really important and very important, obviously, for the long run. So,
And they tie together because
they do, right? Yeah.
in the end of the day, we are the largest consumer franchise in financial services in the United States with 70 million consumers on a core banking, what we do. And so if you think about that, to be there, you had to think about how you were going to engage in businesses. So, which businesses, how are you going to run them? The principles by which you're going to run them were key to create that long-term value because you were the biggest, but if your brand was beaten up and people didn't want to do business with you, you weren't going to stay the biggest. And so we had to play through that. So they do tie together. So the regulatory cleanup and the cleaning up the issues of the past tie into a great brand consumer client experience that then leads you to the future. And that happened across all the business. Consumers just easier for people to visualize.
Right. No, that's really helpful. But it's a good. Do you see parallels from that time to today? Obviously, we haven't had the sort of financial crisis, but we have had changing regulations. We have a lot of, there's been a lot of consolidation. I'm sure there are lessons that lesson of how do you keep your mind and your mind's eye on that long run, even with all the uncertainty of today, is something that people are struggling with, as we speak, whatever today's uncertainties happen to be, even if they're a little bit different than they were at that time.
Yeah, you always are thinking about what's this going to look like, added to over leverage is over leverage. Whether it was in the late 80s and early 90s on real estate, whether it was the fallen angels in the 99 2000 timeframe, the dot-com, which was leveraged in a different way, and then into the financial crisis, which was leverage in the consumer credit space, and then the securitization, other things, and then leverage today in some of the leverage lending. So, leverage is consistent, and those things, when it gets out of hand, it causes trouble. And these are leveraged balance sheets by definition. So you have to think through all that as you're going through it. So yes, the themes are there. There's a new theme though. It's not a different theme, but it's the extent to the theme of which technology can affect business process is changed. Not that technology hasn't affected business process for many, many, many years, and probably for all time. It just was different technologies, but the implications of what technology can reach for the next decade are different than what it can reach the last decade. And that's an interesting question. So that could create another pluses and minuses that we all have to think through.
Well, let's jump to that then. As you think about, I know you're deploying AI throughout your business. How do you make those long-term decisions when the technology is changing so rapidly and nobody knows exactly the way it's going to come out? But can you tell us a little bit how, in practice, you decide where to lean into the technology, where to take a step back and let it, let somebody else test it first? How do you grapple with that? Because that seems to be a very difficult challenge for many businesses today.
Right. So I think a way to think about that is we are an innovative company. We have more patents than any other financial services company. One of the top 4 or 5 patent companies, whatever it is, in the country. We have thousands and thousands of people have been granted patents, so the people are always innovating. But innovation has to be coupled with a couple things. One is it has to be coupled with a customer ability to absorb it and use it, or teammate ability to absorb it and use it if it's in some internal process. And that customer can be a corporation or an institutional investor, your heritage, or an individual and individual investor and individual consumer. So it has to be able to be used. Then the piece that makes it different when you're at the scale we are, it also has to be able to scale, because science projects are uninteresting. So the question isn't, is this a good technology? The question is this a good technology which customers can figure out what you're doing for them, and we use it, and then we use enough of them use it to make it worth deploying and making sure, because it has the cybersecurity around it, the never down idea that always has to be available around it, the care and maintenance and feeding of it. All those things are so important that you can't deploy technology unless it has all that when you're our scale. And so you'll see outages among companies and stuff that people are like, oh, that's too bad. We have an outage of like 2 minutes. The world's like, oh my God, I can't get my money and stuff like that. So we have to think about technology deployment differently. If we can't trade securities for institutional clients because something went wrong, even though we got the sexiest technology in the world, they're not going to be very happy if they can't move what they need to do. So that's the balance you have to have. So in it, you have to be extremely innovative, but you have to think about customer adoption capabilities. So when you think about AI, that's what's been interesting. For us, AI started a decade ago with a simple question. It was a customer question, which is, in our mobile technology, our digital technology, could a customer search and get answers to stuff rather than have to call people to get answers? So we deployed a search engine in there, and it gave answers that were pretty odd. If you asked it what your balance was, which you'd think in a banking app, you might get your checking account balance, you might get whatever you would get by searching otherwise. You might get a picture of a scale. You might get an invitation to a yoga class. You might get to, do you need are you in the science field? And do you need a balance to do something? And so we said, here's the customer problem. The customer doesn't want to call us and ask us about this stuff, or walk into branch, or all this stuff, or look it up, or paging through stuff. So we said, here's a question. So we had someone develop at the time, a model to help answer these questions. We gave it insights, 200 ideas. Could it answer them? That's where it started. And could it be clear enough on the answer? And could it convert customer language to bank language, policy, procedure, manuals, and systems interface, and then come back out with an answer the customer can understand and be satisfied with well enough that they wouldn't get frustrated and go back. And that was Erica 10 years ago. And in today's parlance, small language model, on-prem, and all this stuff, nobody knew what they're talking about back then. And that's why we had to go to somebody and say, we need this solution. That became Erica. Erica now has 20 million plus consumers using it. They use it all day. We took Erica, put it in institutional business. Institutions are using it. We took Erica, put it in internal techniques to order equipment in IT, or break fix, or change password. It does all that. And so you're hanging out. Now, Erica is a fairly simple model, and there's much more sophisticated models. And so there's many. But it was that combination of customer ability to use a technology and the ability to build it, that they could use it, and that combination come out. That's what made it innovative, because it got to 20 million consumers, relatively quickly. And does it? And if you go back to the other challenges, how then do you manage the human relations case into this thing? So it's 11,000 people equivalents are being handled in Erica on a daily basis. So what do we have to do? We had to think about headcount management all during that time. So as people retired or left our company, we didn't replace. So that if you go back across the last 15 years, which is a lot further than we've had Erica, but with all the technology, we've gone from 100,000 people in the consumer business to 50-some thousand. And yet we've done that with no layoffs and no mass. We just let attrition be our friend. And our attrition rate is 8%, which times 200,000 people, 16,000 people. That means each month we got to hire 1,000 plus people. And if we're careful about what we hire, we can manage that headcount. And that's what we've been doing for years and years and years. So there's not only the technology innovation, the customer side, but it's also the human being side. So our teammates embrace it and drive it, as opposed to are fearful of it.
Mm-hmm. Yeah, no, that makes a lot of sense. And I think that as we think about, for the long-term impact of AI on capital allocation, it's also just fascinating, because of course it's drawing so much capital directly in terms of data centers and infrastructure and all that, but it's also changing the competitive dynamics between different companies and different countries, and therefore changing long-term capital allocation around the world. And so, as we're thinking about sort of the interaction of AI and long-term capital, it of course is affecting probably everything in our lives, but in our world of long-term capital, um, that's what's fascinating. So, do you have any guesses what the 5 or 10 years from now, what's your guess as you look at the crystal ball? How will this just be a continuation? You've been doing this for a long time. A lot of people feel a little bit like this came out of nowhere a couple of years ago because that's when it hit the consumer space. But how do you see the trajectory?
Well, in 5 years, we'll be, what, 1,800 more days into this, so we could figure it out. It really, it's hard to say exactly, and because you can get estimates that, we're never going to have to work again to, it's not going to change much. And so, by the way, that's all irrelevant. The question is how you're going to apply it in your company and how you're going to do it in a way that your clients, your teammates, your shareholders, and your communities in our case, benefit from it, and thinking about all that stuff. So it's less about, what's what a 5-year, 10-year view. There'll be more of it. It'll be more deployed. It'll be more naturally impacted. We think its highest and best use in the near term is embedded in process to help teammates do more work and become more efficient, whether it's investment banking preparing a pitch book, or whether it's a lawyer working on legal work, or whether it's a person doing achievement processes in our back office processing, having a better way to get those very complex rules, which are different for every state and everything else, ability to interface with those rules because the customer pops up and they're from North Dakota. You got to know the North Dakota rules, and it's not like we get a customer from North Dakota every day having this sheet because it's a narrow customer. So there's plenty of ways it'll operate. So I think to say, anybody has a definitive interest, what insight as to what happens. At the end of the day, what is there'll be more of it. It'll be more pervasive. It'll work with teammates. It will be work directly with consumers and companies in certain applications. Erica does today. And, all that will be good, but it all has to be, the hardest part of this has nothing to do with it. It has to do, is the data right? Is the decision right? Is the controls around it right? And those things are the hard part. So the easy part is actually conceptualize the use. The hard part is to actually have it so that when we went from 200 inferences or insights in Erica, which is 200 questions it can answer, make it simple. It now has 700. It could probably answer 10,000 if we tried, but you want to make sure everyone answers right, because then the usage continues to grow. So that the gating things on this are, is your data right? Can you distribute it in real time and pace? Remember that, we have 45, 50 million digital customers. They touch that mobile banking app. It's 110 systems sit behind it. They could be in a car going 60 miles an hour. They could, be on a phone with okay connection, and yet they want that answer perfectly in their hands today. So there's an element of sounds very mundane here, which is your data right? Will it give the right answer? And can you get the right answer to the person in a time frame and a capability that it'll be useful to them? And if you start saying, oh yeah, I can give you the answer in 10 minutes because the machine has to take that long to operate, or I can't transmit to you. So there's a lot of stuff that will go on, but in the end of the day, it'll be more, it'll be better. It'll help us serve our customers better, help our teammates be better. It'll generate more returns to the shareholders. And ultimately it'll, like all technology in our industry, it also provides a heck of a benefit to our customers because a lot of the benefits still get priced through to the customer at the end of the day. If you look at the return on assets across our industry, across time, all this innovation and all this efficiency, continues to go back to the customers, whether corporate customers or investing customers or consumer customers, institutions. We keep pushing it back, and that's where we have no revenue from any consumer retail trade today. It's been like that for 15 years. It used to be $5 a trade, and it's down to zero. So there's nowhere you can go below zero, but that was enabled by the technology. So I think there'll be benefits to customers too.
Yeah, no, that makes a lot of sense. And you've used this phrase responsible growth over time. It sounds like you're thinking about responsible growth in many, many ways, in terms of your core strategy, in terms of your AI strategy, in terms of your workforce. Like, how do you actually take a phrase like responsible growth and implement that in decision making in such a large, organization where, again, you have lots of people making decisions. I'm sure you make the ones that are the toughest ones, but you've got people making decisions every minute of the day And they again are having this. So what's a short-term decision versus how do I set myself up for the long term? How do you sort of get that through a big
Right.
organization like yours?
So oddly enough, in the environment of 2026, people look at responsible growth and think it was about being responsible. It was actually the opposite. We'd come through sort of all this work from 2010 through say 2015 or 16, and what I said is we have to grow. And so it was about grow the right way. So grow the right way with risk, grow the right way with customer focus, grow the right way with sustainable growth. So you're investing in future growth at all times where you're doing it. So the third, the sort of core pillar has three elements. You be the best place for teammates to work, share our success with our communities, and drive operational excellence to pay for all this stuff, right? So that doesn't sound like, revenue producing or anything, but that's the core to what keeps this engine going in a commodity business with lots of competitors, with lots of pricing pressure that you got to drive it. So responsible growth says, yes, we got to grow, no excuses. We got to do it with the right risk. And it gets talked about in that context, but it's really about, okay, you got to have the best teammates who are how we pay, how we promote, pay for performance, our access to continuing education, our childcare benefits, all that is to have a group of teammates who will make the company even better. Well, and then we have to share our success with our communities because our communities, need it to be. If they're not successful, we're not successful. So we have to do that. That's brand building too. And then we got to drive operational excellence and constantly improve the company, take that money out and invest it. So responsible growth is a little broader than that, but it was a call to growth in 2015, 16. It remains a call to growth the right way. And when people say, are you too responsible, too growth? You're saying the answer is and. It's the genius of the and, not an or statement. So you got to be able to do both. But you also have to have a design in your product. So if you take our consumer business, our customer score is the highest ever. Attrition in customers the lowest ever. But our overdraft fees, we took most of it off the table starting 15, 17 years ago because we wanted customers that didn't think of us as a place to be there to have transactions and roll over when the fees got too bad. They left. You wanted people to stick with us for lifetime. And what we wanted to do is work with them to learn how to with them to educate financial education and learning so they would manage within their budgets. Therefore, their cash flow possible. Therefore, they have a strong, these things you do by education, better money habits and the things we have, which are one of the great programs. But on the other hand, you also do it by product design, which says to the customer, consumer, will help you have a no overdraft account. Therefore, you'll never have to deal with paying these fees. But what that will do, though, is stop you from having payments that you don't have the money for. Therefore, think about how you manage that flow, and we'll provide data, instantaneous information about that flow. So, what's happened? Customer scores have gone from X to 50% higher than X. The attrition's gone down a lot. The teammate scores have gone up, and all that's because it's a much better driven business that has a much more stick to the ribs to it than when we used to sell 10 million checking accounts a year and close about 9 or 10 million of them. Now we sell 4 and we get 1 million net. We used to sell 10 and get 1 million net. And think about the different dynamics. That was, in the 2005, 6, 7 range. We were selling, but not getting traction. We changed it in 2008. And it's through the system now at the other side. So responsible growth also has how you design products and capabilities.
Yeah, no, I think that's a great example, which is, we're all taught that your best customer is your current customer, but somehow getting that new customer, even if they don't hang around, has allure to people, and sometimes
Yep.
incentives are set up that way, and so on. Yeah. So, can we talk a little bit about regulatory complexity? You've talked some about regulatory complexity, the importance of institutional stability, central bank independence.
Yep.
So, obviously you're a systemically important institution. How do you think about the sort of living in a world where you have long-term regulations, but then sometimes they zig and zag based on short-term political cycles? How do you manage through that as well? Because I think that's another thing where you've obviously been a regulated business forever, but you mentioned, for example, Merrill Lynch hadn't in the past. There are some businesses that have been regulated, have not been regulated, and it sort of goes back and forth. So, what lessons might you have for dealing with what sometimes feels like changing rules in the middle of the game?
Yeah. So I think a couple things. One is the central bank independence is agreed to by the markets, and the business system is important. That has nothing to do with banking regulation. That is independence in monetary policy and thinking about that question. And the reason why, if you're going to borrow $40 trillion in debt from the world, and you're going to have you need people to say, their job is to make sure inflation doesn't take hold. We don't have the problems other countries have had where their debt has major crises around it. And if you're the largest economy in the world. So the Fed was created to provide, the dual mandate, et cetera. So that is completely different. The banking regulation question is far more complex. And so, what people have asserted over time at the different regulatory agencies is I have the power to do X, Y, or Z. Sometimes that's really based in law. Sometimes that's not really based in law. And that's where I think some of the demand comes through. But I think from an industry's perspective and a company perspective, we want down the middle regulation that doesn't, swing back and forth, because that's hard to adopt the business system. And so we believe that's true. The second thing we believe is that anybody does anybody takes a deposit or makes a loan or equivalent act or engage in capital market, all ought to have the same set of rules. So the theory that people don't have the same capital requirements as the banking system. So you hear about the non-banks and, this goes on and that goes on. You're saying, yeah, but if they're doing the same things, they ought to have the same regulation. If they don't, what's going to happen is the arbitrage is going to take place. Then you're going to have the blow up and you're not going to like the result. So the major part of that was all the firms that basically got in trouble in the financial crisis. The worst ones were generally non-regulated. So whether it was Bear Stearns or Merrill Lynch or Lehman Brothers, whether it was Countrywide, which is a mortgage lender. And so the idea of the financial crisis, we regulate activity, that has not really gotten through. And that's, you got to be careful. So mortgage loans can be done. They've done a pretty good job on mortgage lending, but they haven't done such a good job on commercial lending. They've done and so the liquidity rules are different. So we need to think that through. So we want down the middle regulation. We want to apply to all activities, which was the principles coming out of the financial crisis across the world. And then we want good capital and good liquidity. Good capital doesn't mean infinitely get more capital. And so if you look from 2019 to 2025, the capital industry basically went up by about 30% by a series of manipulations of rules and counting and, how you count the beans. None of it on its surface looked like it was changing that much, but the actual nominal dollars to get the same capital ratio you had because of the rule changes from that time were there. And you start to say, wait a second, that for us, that number, it would stop us from making like $300 billion of loans. And at the end of the day, you're making choices as a series of regulators that you're constraining the banking system from engaging the economy, which is the economy needs, our core thing is we take deposits from people who have excess cash and we turn around and lend them to people who need cash to grow their businesses. And the capital markets do it a different way. And without us with constraining that, it constrains the economy. And so you're saying, is it worth it? And they'd say, so you can always get a person saying, if you guys had more capital, it'd be less than chance of going out of business. You're saying, yeah, but the trade-off gets unworth it. And that's where we're swinging this back now, get it more reasonable. So the capital went way up. We got to get that back in the middle. The liquidity rules were good and they're very strong, but then they started playing around with them and adding things to them that, and it's so complex and so much over double count, so much this and so much that you can rationalize this all and still have good liquidity and good capital. And so that's what we're after, is simplification, and also being mindful that infinite capital may feel good to the person who wants to never have. If we took all our money and deposits and put it overnight at the Fed, we would have no risk. It just wouldn't, the economy would be missing trillions and trillions of dollars of lending activity, and that would not be, the economy wouldn't grow. And that's what we're trying to make sure the balance is there.
Yeah, I think that's the challenge for a regulator, of course. It's again, it's sort of a short-term, long-term challenge, which is in the short term, they don't want a problem on their watch. And that's fair enough, right? That's their incentive. They don't want it to blow up on their watch. But if you
We have this
just
odd thing in our
maximize
industry, which is hard for people to understand, is the U.S. banking system is a self-insured industry. So the debate about, the failure and the government bailout of the FDIC, all that money is paid for directly by us, not theoretically, directly by us. And so when, Silicon Valley Bank and the other failures took place, we paid for that as an industry. And in fact, the bigger banks had to pay more because of the way the rules were. And so there are a lot of people talk about the government's money. It's not at risk. It's not like, this is more like a Lloyd's insurance syndicate where you have, yes, there's one person who puts their name on it, but all the risk, i.e. the FDIC, but all the risk is attributed back to the industry. It is not like other programs of the federal government, where the federal government actually bears the ultimate risk. So, or you try to spread it at a price. This is direct pay. And so one of the hardest things to get people to understand is all the people have the highest and best interest in keeping the industry sound is actually us because we pay for it. And that's why I say, regularly, you'll be gone. Our company will be here and paying for your failure to supervise, this capability or have a rule which addresses all the activities. So it's an odd position to be in where everybody talks about what the regulation ought to be to save the government money, and it's your money they're talking about, and they sometimes don't even talk to us about what the real risk is, and it's sort of an odd place to be. And at 14% of all deposits, if every failure, you assume we're writing a check for 14% of it. That's what happens. So I have a higher interest than the government does because our institution's 250 years old, the oldest parts of it, 240 some years old, and it'll be here. And the regulators will be off, retired, or doing something else, and we'll still be paying for the mistakes. So we're trying to say, listen to us. That's what happened in the failures in 23, is we stepped in and stopped the music, and we're able to help them because they actually engaged with us to talk to us about what they should do. So we put $30 billion in deposits into the First Republic, and people said, well, why'd you do that? Well, because we're on the hook anyway. So we tried to stabilize it to see if it could last long enough to do something more constructive with it. And that's what happened.
Your analogy to a Lloyd syndicate's an interesting one. I hadn't thought about it like that, but that makes perfect
Yeah.
sense. So as we, you've committed a lot of money towards environmental finance, sustainable business activities, but you're trying to sort of deploy capital at scale into the energy transition, climate adaptation. That clearly things in this world have changed, regulations have changed, attitudes have changed. But as you think about again the long-term trend of decarbonization, different sources of energy, what the climate is doing, the extreme weather, all of those sorts of things. How do you think about getting more capital into the infrastructure that is going to be required over time to manage through those sorts of transitions as our physical climate changes?
So there are a couple of principles. One is we are a bank, therefore we're doing what our clients are doing.
Mhm.
We don't do. We have energy consumption. We have lowered that through efficiencies and effectiveness. We have put solar panels on tops of branches. We have helped enable solar deployments, major solar deployments, and bought the energy like you're seeing in the data centers. We've done that over time. So we've done that a lot to lower our things. But look, that's $100 million a year of energy spend or something like that. So it's not going to change the course of history for the world. But what we do is finance all the other participants in the economy. And so what we did is we made commitments to keep our focus not only on our core business, but also on people who are investing and borrow, and therefore need to borrow along all these projects. And so that's what it's done. But it follows the customers. It follows what they're doing. And I think so. As you think about this, the idea is to have energy for all, fair price for all, and to make progress on sustainability. The oil companies I work with continuously, we finance a lot of my work with them, a thing called the SMI and other things. They're all sitting there saying how they first take it out of their operations, inefficient carbon use out of their operations, which they're doing, methane flaring and those things. They're working on all that. And most of the majors have done it, but they're helping even the smaller companies. So you start with that. Then you start with how do I make the process better, and then I thought how do I get fuel efficiencies up, and so there's a lot of work that can go on absent switching a complete system over, and so you need to have all that going on. Now, interestingly enough, so I think what happens, like all things, this thing's swung back and forth, and what people weren't thinking about is you really need to make sure your people can have electricity and heat and computer power and industrial production power. And if you screw that up, it doesn't work from a societal basis. So right now, what's been interesting is the amount of activity in the United States. Texas is the fifth largest renewables producer in the world. And so the wind products out of the Midwest, the stuff going on has been huge. The solar capabilities out of the desert areas, these are huge installations, which are very strong and add to that grid, and a lot of the incremental activities come off it. Meanwhile, we have 13 million barrels where we're at today, which is, back to peak levels, and that's going too. But I think the piece that people you hear talked about more, which has become the interesting part, is energy independence. And so if you're sitting in a country that doesn't have the energy resource in the ground, and or you're sitting on an energy resource your citizens will let you use, which can be the case in certain types of energy sources. Citizens won't let you go in and pull it out of the ground or whatever it takes. So if you think about that question, that changed this dynamic. And so there is a way that you can get to energy independence without going down a fossil fuel outcome. That's what countries doing. And as recently today, if you saw that, the China EV sales were 54% of sales because by electrification, they're not importing all that oil. Therefore, they're not importing, their GDP per capita is X. The GDP per capita countries also using that oil as multiples of their X. And their citizens are trying to drive a car. And you're saying, well, if we can produce really cheap electricity, and unfortunately they use too much coal and they're trying to change that, but if they can do nuclear and they can do solar and they can do hydro and that can come in, these electric cars will have us as we become car users of high order and transportation users of high order. It will not have us have to import that inflation. So what people can confuse about is decarbonization also is now a question of security, which is then I have my own energy source. Then I have an energy source which I don't import inflation and import or expose the world my lack of capability of buying energy because of the dynamics of my population and GDP versus other populations, and we're all competing for the same barrel of oil. So this has many more turns in track. But at the end of the day, we continue to support all the businesses, both oil companies who are in the production of oil, but also are massive investors in new energy technologies and capabilities, and they have some of the best carbon capture storage, et cetera, et cetera. And then new companies also bring on new sources, and we're doing it all. And that's what's interesting, and that's what's generating this power demand. Now we got a new demand for power that's going to create an extra demand, and it's interesting to see people going after it, right? Everything from hydrogen fuel cell production to gas versus local gas production to new nuclear production to trying to figure out ways to in the Middle East right now. One of the major firms is deploying a gigawatt permanent battery and solar capability to drive data. So these are interesting things, but and you got to be careful they're not uniform. Different places can have solar because the sun shines so much better, and they can be more dependent. They also have open land, so you can put the battery farms out there to store it on intermittency and stuff. So there's a lot of complexity to it. We've learned a lot about it as an industry. We've learned a lot about it as an environment, but it's just relentless because in the day you can drive down the cost and you can have the energy independence. And those two things are much different now where we are today than we were 10, 15 years
Yeah. Yeah. And the technology and the differences are so important, as you said, around the world, because different people have different resources at hand, and some people have sunshine, some people don't, some people have water, some people don't, et cetera. I think that's one of the things that's just fascinating. We'll probably see really different solutions around the
ago.
world over time. Yeah. Yeah. And the
But the
energy.
long term is, the energy companies we work with are massively driving into efficiency. The car companies have massively drove the fleet miles driven and use of gas for that fleet mile driven in the United States. It's been relatively flat or down. You think about that. That's going from a 3-speed transmission to 5-speed to 6-speed to 8-speed to 10-speed. All that makes them more efficient. So everybody's working down this travel cars or lighter cars. So, where people get caught on one technology or another, it's going to take all these technologies moving the dial consistently and then capture, both nature-based and technology-based. And, and then, nuclear went from being completely anathema to now people say, wait a second, we should be thinking this through. And then the question of fusion or something out there. But, even near-term nuclear, small modular and doing it different ways, and the safety and security and the ability so Japan that went away from it is now going back to it. And, that for a country that has to import all their sources of energy, that's a huge difference to them to have the efficiencies of nuclear production. And so the world keeps shifting on this, but I think as I talk to businesses, they all know that they're thinking about long-term. And at the end of the day, we've got to make sure the earth stays balanced here, and they're working on their tail off and figuring out how to do that. But they're not doing it in a way that is a cliff. They're just saying, we just got to keep chipping away.
Right. And I think that's the way most businesses succeed is not overnight. It's just chipping away over time at things. That's right. Well, we've talked about a lot of things. We've talked about the decarbonization, the changes in energy, the changes in the technology. We haven't talked much about demographics. We think that is a disruptive force. But if you sort of take a step back and think about looking at 5 or 10 years or whatever you can see, kind of long term, What do you think the markets or the general discourse, if you will, is underestimating today? That where capital, long term capital, should be paying closer attention than probably is paying attention today.
Yeah, I think it- this question of technology adoption and deployment in major companies that may have competitive risks they didn't have before, yeah, because of feature functionality capability and you know, availability of technology to every consumer's fingertips, et cetera. These are that's a trend I think which is still there. And then so I think figuring that all out, and as people think about where to invest, you have to think about are people using this technology and staying ahead of it, and transitioning capabilities and things like that, but also getting an economic turnout and creating and not getting ahead of their customers and making sure the ideas stick to the ribs and have that. That's sort of one thing. And you got to always remember, you can't be ahead of your customers and do things that they can't absorb and change to. And so that's the gating factor. So an idea is an idea which gets, as we talked about earlier, gets adopted and then be able to be scaled and be able to be used by the customers without having to think about it. That's a real idea. And that's what I think you'll see. And I think the technologies allow us more today. When you think more geopolitically, obviously the trading and tariff and world order and the multilateral treaties and all that stuff is all sort of being played out. But I think you have to separate that a little bit from the other thing that we talked about, which is the ability to deploy the means of production around the world has now had another step change. Why? Because if it's more data centers and systems, those can be deployed all over the place. And if you could, because it's land and it's capable of coming there, and the safety and security around them, they don't get taken or something. So that kind of changes things. And then the question is, with the ability to have energy without having to, put it on ships and ship it around and things like that, and even data centers in the sky and things. You think about this ability that you're separating work location from work and its location can be separated in ways that we all learned in the pandemic because we thought people could never work in the office. They didn't, but we've also learned it more and more. So now the question, when you go to population dynamics, there's always a immigration for opportunity question, which is going to have a different element to it in the future here, which is the need to move to find the best jobs is not as high. And so you wonder, what I think about is over the next 10 years, countries that have lots of young, talented people, how they're going to participate. The typical way over decades was kids came to the US, UK, Europe for school, kids learned and then stayed there. I'm not sure that has to be true anymore. So I think there's going to be a leveling out of their ability to be collaborate on research on a global basis without leaving their country, or come and get some training and go back and be able to, so there's an interesting thing to all this, I think, which is fascinating in terms of population dynamics, which may allow people to stay spread throughout the world as opposed to constantly trying to concentrate in certain places, Singapore or Hong Kong or Mumbai, because that's where the opportunity is, or New York or London or Paris or the Middle East, and therefore you draw all that. There's an element that will never go away, but there's an interesting question of how this now and the quality of life that you can employ at a distance through these technologies is pretty substantial. I mean, you start thinking about the ability to analyze vision problems around the world locally by using the same technology you'd use if you're sitting in the best place in New York City or something like that. That's pretty interesting. And so I think I think people are underestimating that impact and what that really does in terms of some of this geopolitical strains and things.
Okay, so that's terrific. Well, thank you so much for your insights. You're helping us is vision in a long term way. Thank you for your support of FCLT Global, along with all the many other things that you have on your plate. Thank you for spending the time with me today.
Okay, Sarah. Thank you. Happy New Year, and I enjoyed it, and I look forward to seeing you again.
Sounds great. Thank you.